Is it on? Okay, now it's okay. Thanks. Okay, so it's a very interesting paper looking at how the turnover and the performance sensitivity are different across public and then the private firms, and that's really interesting because we can test these two kind of conflicting the hypothesis regarding the CEO turnover. So one is the, as Kai explained, the entrenchment hypothesis. So based on this, we expect that these private firms are going to have more performance and turnover and the performance sensitivity because as the private firm CEOs are less entrenched, we expect that their turnover decision will be more sensitive to the performance. However, this myopic view tells us that the board of directors focus more on the short-term performance, and that's why even though the managers take a long-term view at the expense of, let's say, short-term performance, they might be actually laid off. Okay, so that's why kind of interesting. It provides an interesting setting, and this myopic view will tell us that hey, there should be more turnover performance sensitivity for the public companies. And as Kai explained, they found that significantly greater likelihood of CEO turnover in the public companies, and also they find stronger CEO turnover and the performance sensitivity for the public companies, which is against the entrenchment hypothesis. Okay, and then they, for the test, I show that actually the improvement of the performance after new CEO hire is greater for the private firms compared to the public companies. Okay, so this is kind of used as a support for this myopic hypothesis. In other words, if let's say CEOs were fired because of this short-termism, myopia, then whereas the private firm CEOs were fired optimally, then we may expect that the new CEOs will improve the firm more in the private firms than the public companies. So that's kind of the basic idea. Okay, so I think already Kai explained well about the entrenchment and the myopia hypothesis. I'm going to just skip. And first, I'd like to clarify a few things. First of all, it looks like that they measure this performance of the laid-off CEO using the annual data, right? So here the T is the year of CEO turnover, and the same year ROA is used to check the performance. Actually, they use the 2-year cumulative performance, T-1, and the T, which is the year of CEO turnover. What if the CEO was, a turnover occurred early in the year? Then actually, the year T performance will capture large part of new CEO's performance, right? Because, ROA during the year of turnover covers more than half of the period where the new CEO actually, joined the company. And more concern is that if new CEO lowered the profits significantly to, engage in so-called the big bet. Right? We know that new CEOs oftentimes intentionally lower the profit, right, to start from the bottom, right? Then the measure used here to capture the performance and sensitivity will actually make the result of the greater turnover performance sensitivity for the public firms if there are more big bet going on among the public companies, and which I think is the case given that the managers of the public firms are going to be more concerned about the compensation, which depends on the performance measures like stock returns or the earnings performance, and if this is true, in other words, if we find more big bath going on among the public companies, I think this is a kind of one serious issue you have to consider. And one possible way to fix this is if you can find out when CEOs were fired, then actually you can use the quarterly data instead of annual data to measure the performance before new CEO started. I mean the performance ending before the new start, right? So that will be a way to avoid this so-called big bath, the concern. And actually, I was wondering about that, who are reporting the capital IQ, but Kai already answered the question, so I'm not going to address this. But I was wondering, but still I have a question. If those with more than 500 shareholders are required to report, then how about others? I mean, it looks like there are some others who are voluntarily reporting, and capital IQ actually capture that. So I just wonder whether your sample include those firms which are not required to disclose, but they do. So I was wondering about them. Okay, and so these are the list, but let me go one by one. Not all, but just few of them. So the first thing is, this is a difficulty of comparing public firm versus private firm, because we expect that the characteristics are going to be very different between these two, and actually they carefully check that out and show that some of these results are quite different. But later they actually check CEO tenure, the board independence, ownership concentrations, and so forth in the paper, even though Kai didn't have time to explain about it. And I think you may want to check whether or not those are also quite different, because for example, let's say ownership concentration, I expect that it's going to be different, but what if it's not? Then actually your underlying assumption about less agency problem and things like that may not hold in your data. So I think it might be better to check those. And this is a minor point. Okay. Yeah. And this was kind of the concern I had without knowing that disclosure requirement. I was wondering whether or not the private firms, the records are updated as frequently as the public firms. So to check whether that's the case or not, I actually checked one private firm I know for sure, which is Dimensional Fund Advisors. I worked for 3 years, and I went there and checked the information of the DFA in the capital IQ, and I just checked the professionals, and I checked my name, and it was still there 4 years after I left the company as a professional. So I was kind of wondering, whether the information about the private firms are, updated as frequently and as accurately as public companies. Okay, but given that disclosure is required for those firms, it's a less concern, I guess. But I think you might want to check whether what percentage of your firms include those who are not required to report. Okay, and so this is going to be my last comments. You actually check whether or not, the firms with more myopic investors are engaging more in this kind of myopic, CEO turnover decision. And to do that, the paper actually use a dummy variable to indicate a companies with more myopic investors. Okay. So what they do is actually identify those firms with a myopic investor ownership, the transient ownership, greater than the median of the sample firms. And I just wonder, what was the median? Okay, because of course they may just be concerned about the so-called Wall Street workout, but at the same time, just wondering whether or not the board is dominated by those guys who are, concerned about those short-term investors, or it's dominated by those who are, dedicated. In other words, I'm not quite sure why the board, may concern so much about the short-term investors if they are dominated by those who represent the dedicated investors. So in other words, it's really difficult to tell, but at the same time, I'm just wondering who those outside directors are representing. Myopic investors or the dedicated investors. Okay, so I think it might be interesting to check and think about why should the board represent the short-term investors' interest if the myopic investors' ownership is small. So in that sense, I want to know what the median was, okay, and whether there was a significant portion of the ownership or just the small portion. Okay, and there are some the indigeneity issues and others, but because of time, I'm going to stop here. Okay.
I have actually two quick questions. How do you know? So when you look at private versus public companies, how do you know that it's in private companies? It's not more CEOs who are maybe family members, etc., and there you would actually expect less turnover sensitivity, which is kind of the result you get. And then looking at public companies, how do you know that it's not selection, that companies just for whatever reason happen to have more turnover, and investors, myopic investors, self-select to own those companies instead of investors driving that? And I think you can check both by, here you could look at maybe investor, like as investors change, whether that changes the CEO turnover sensitivity or something like that.
I thought those were really interesting results. So it's very clear that in public firms there's greater sensitivity of turnover to performance. So my question is on the interpretation of this as myopia as being inefficient. So I know you do a battery of tests to try to address that. So one of them is just following up from Marina's point on the selection